Coming up, a shaky start to the year for Philips and the end of an era, as the electronics giant quits the home entertainment business. And watch out for Yahoo's shares today, they could be set to rise after the internet giant said revenue will climb this year. But first, our top story this morning. Philips says sales in the first half of the year will be slow, but pick up in the second half.
Mixed picture. We think that it is wise to have this cautionary approach to the start of the year, but regardless, we feel confident about our ability to further improve our operational results.
The Dutch electronics, lighting and health equipment giant reported a Q4 net loss of €355 million. That was larger than expected and due to previously flagged provisions. And after exiting the TV business last year, it is selling its audio and video businesses to Funai Electric for €150 million. Shares in Industrial and Commercial Bank of China fell today, putting a drag on the broader Hong Kong stock market. For more on that story, John Gordon reports from Hong Kong.
Need some quick cash? One solution for you: sell $1 billion worth of shares in the world's largest lender. That's what Goldman Sachs has done, offloading yet another chunk of its stake in the Industrial and Commercial Bank of China. So why are they selling now, just as China's economy is on the rebound? Well, one reason: the new Basel III rules. They raise the amount of equity capital banks need to offset the risks of holding minority stakes in other financial institutions. Another reason may be fatigue. Instead of trading their expertise for market access in China, many Western banks who bought these stakes back in 2006, 2007 are finding themselves in these one-sided partnerships with few prospects that the country's financial sector will open up further with more liberalization. Goldman bought its then 4.9% stake in ICBC back in April 2006. That was just before the Chinese bank's Hong Kong IPO. So yes, a handsome financial reward, but disappointing for Western firms that had hopes of gaining traction in China's now massive banking market.
Here in Europe, consumer sentiment data from Germany and France has just been released. For more on that and other key stories out of Europe today, we are joined by Mike Gallagher, Managing Director at IDA Global. He joins us from the LSE. Mike, German consumer sentiment edging up, France flat. Is this another indication that the core in Europe is starting to diverge a bit?
I think there is a big sort of divergent story there, and I think France is probably more critical than Germany. Germany's being supported by the recovery in Asia and by the better structural position, and I think Germany is going to escape a recession. However, we think that when we see the data for Q4 and Q1 GDP, we will see that France is in recession. And I think that's going to be one of the big sort of disappointments and one of the big stories as we develop through the course of this year. OK, now that's the core in the Eurozone. The periphery, we had some numbers yesterday from the ECB. It looks like capital is returning to the periphery in the Eurozone. Is this a sign that the capital flight we saw last year, that's come to an end, and essentially that the Eurozone breakup story is a thing of the past? I think that the sentiment shift is both European-driven because of the ECB OMT existence, but it's also a global asset allocation shift that's occurring. I think if you talk to fund managers, they feel that there's no major sort of tail risks on the horizon. Now that the debt ceiling's been kicked into to May, consequently, people feel that they're overweight safe havens and underweight riskier assets, whether it's Spanish and Italian bonds or emerging market equities, and that they're overweight and need to get out of the yen, the Swiss franc, gilts, French bonds. I think that, there's vulnerable safe havens there that people are shifting funds out of, and part of the destination is Spain and Italy. OK, now you mentioned Italy. I just want to finish up here. The finance minister, Vittorio Grilli, he apparently met with ECB chief Mario Draghi yesterday as this scandal at Monte Paschi, Italy's third largest bank, it seems to unfold and unravel. Is that a reason to steer clear of Italian bonds, especially with the elections coming up in a few weeks? No, I think they're very much regarding that story as very much company specific. I think the market's aware of the long-term structural weakness of the banking system in Italy, but it's not sort of a prominent concern near term. I think the critical question in Italy is actually what happens in terms of the Senate. And if we continue to see Berlusconi gaining ground, there's a risk that the Senate could be quite messy. So come mid-February, I think we'll start to see profit-taking on the great run we've had in Italian bonds. For the moment, though, the market remains quite constructive and we can see some further narrowing of spreads.
OK, Michael, thank you very much. In world news, violence continues overnight in Egypt as protesters defy a nighttime curfew imposed by Egyptian President Mohamed Morsi. Police stations were attacked and at least 2 men died in the fighting in the city of Port Said. Clashes also erupted in Morsi's hometown. The death toll in the 5 days of violence now stands at 52. Political opponents have spun Morsi's call for talks to end the violence. French and Malayan troops have retaken control of Timbuktu after Islamist rebel occupiers fled the ancient Sahara trading town. This comes after French and Malayan forces took control of Gao, another major town in northern Mali. The US and EU are backing the French-led intervention in the country against militants they fear could use the country as a springboard for global attacks. That's it for now. I'll leave you with our pick of the day. Could Manchester City's Mario Balotelli be heading back to Italy? There are reports that suggesting that AC Milan and Juventus have held talks with City to buy the somewhat colourful and controversial striker. I'm Jamie McGeever. This is Reuters.